You've been showing up to work every day, clocking in, clocking out, and quietly assuming that if something happened to you, your family would be okay because your employer covers you. But what if that safety net had a giant, invisible hole in it that only appears the moment you actually need it? Here's the uncomfortable truth about group life insurance. It's one of the most misunderstood benefits in the entire American workplace. And millions of people are sleepwalking through a coverage gap they don't even know exists. Think of it like renting an umbrella from your office the second you walk out that door. You're standing in the rain, wondering why you never bought your own. The system was designed with good intentions back in the mid-20th century, when lifetime employment at one company was the norm, and the idea of job hopping every 3 years would have seemed almost unpatriotic. But the economy evolved, the workforce became fluid, and somehow the life insurance model just didn't get the memo. Most employer-sponsored group policies offer coverage equal to 1 to 2 times your annual salary, which sounds reassuring until you realize financial planners typically recommend 10 to 12 times your income to actually protect your family's lifestyle. So you're walking around feeling covered, but you're essentially showing up to a hurricane with a hotel shower cap. When you leave that job, whether you quit, get laid off, or the company downsizes, that coverage typically evaporates within 30 days, sometimes less. And here's where the behavioral trap kicks in. People are so focused on severance, job searching, and health insurance that life insurance doesn't even make the mental checklist. Now, you might be thinking, I'll just get my own policy when I land the next gig, and that's where the real danger hides in plain sight. If your health has changed between jobs, a new diagnosis, a chronic condition, even a prescription that raised some flags, private insurers can now rate you up, exclude conditions, or deny you entirely. There's also a concept called portability and conversion that most employees have never heard of, even though it's buried somewhere in their benefits packet like a legal Easter egg. Portability lets you keep the group rate for a limited time after leaving, while conversion lets you switch to an individual policy. But conversion rates are notoriously expensive, and the window to act is usually just 31 days. Historically, gaps in coverage during life transitions have been one of the most common factors in families facing financial devastation after an unexpected death, not because no insurance existed, but because it existed just long enough to create a false sense of security. It's the financial equivalent of thinking you passed the test because you studied the night before, only to find out the professor changed the syllabus. Here's the broader pattern worth recognizing. Americans dramatically over-rely on employer-provided benefits as a complete financial plan, and life insurance is just the most dangerous example of that tendency. The community of independent financial advisors has been saying for decades that portable, individually owned term life insurance should be the foundation, with employer coverage treated as a bonus, not the whole strategy. Let's kill the biggest misconception right now. Many people believe that because they're young and healthy, the gap between jobs is just a minor inconvenience with statistically low stakes. But the entire premise of life insurance is that you're buying it before you need it. And a 30-day uninsured window is exactly the kind of low probability, catastrophic outcome scenario that insurance was invented to address. The practical lesson here is embarrassingly simple. Get a personal term life policy while you're employed, healthy, and have income to qualify on favorable terms. Lock in your rate in your 20s or 30s, and you'll pay pennies compared to what the market will charge you if you wait until a health event forces your hand. Discipline here doesn't mean buying the biggest policy you can find. It means right-sizing your coverage to your actual financial obligations, mortgage, dependents, debt, income replacement, and treating it like a utility bill, not a luxury item. The people who get this right aren't financial geniuses. They're just the ones who made a boring, unsexy decision one afternoon and never thought about it again. At a philosophical level, there's something deeply freeing about knowing your family's protected, regardless of which company happens to be writing your paycheck this year. Coverage that travels with you, not coverage that belongs to your employer, is the only kind that actually reflects the reality of modern working life. So whether you're between jobs right now, starting a new role, or just someone who clicked past the benefits enrollment screen without reading it, this is your sign to audit what you actually have versus what you think you have. Preparation isn't pessimism. It's the most optimistic thing you can do for the people counting on you. And if you're ready to take the next step in building a stronger financial foundation, whether that's real estate investing, home contracting, work, or connecting with the right lenders, check out our links in the description below.